Hey, folks, welcome back. What can I say, man? The market is absolutely on fire today. There is just a lot to be said today. I do want to say that today's it's not probably, it is an overreaction to what is slightly good news. I will say it's slightly good news because it is actually the first concrete sign that we have that the Fed's actions in terms of raising interest rates are having an effect on inflation itself. We've already seen that's having an effect on the employment picture, on the cost of capital, which is a really big thing, guys. The cost of capital for companies moving forward. This is one of the reasons why you've seen valuations of stocks, particularly tech stocks, be absolutely punished. And um, there's not all the news is good, and we're looking at companies right now reducing earnings expectations. There's a couple of ways to look at this. They're reducing expectations and they're trimming the fat in terms of employees that are not as productive, right? In a lot of cases. And I think that these companies have probably wanted to do this for a while. There's been a fire lit under them for the last 2 years to just get warm bodies in companies. And it's resulted probably in a lot of people being hired into positions that they're probably not the best fit for, right? And particularly in the IT world and development world. I know from working in IT for a long time that for every 100 programmers you hire, only 10 of them are actually going to be good. 40 or 50 of them are going to be mediocre, and the rest of them are just dead weight, right? But even getting rid of dead weight in in an environment like this can be kind of difficult, and because you keep waiting for these people to perform. But the companies are taking the opportunity to do this, and this is going to have massive implications on the bottom line. So this has caused me to reevaluate a couple of different companies that I'm looking at right now. Tesla and Twitter, of course, included in that, but also Upstart, which just made or did filings. In fact, we're going to take a look at Upstart kind of closely, their earnings today, which is not something that I've ever done, which is talk about earnings on a live stream. So I'm going to go ahead and talk about that. And I'm going to start off the picture saying that it's not good at all. Let me remind you that I hold Upstart stock. I've got close to 1,000 shares. Actually, I think I have exactly 1,000 shares. My average cost is going to be right around $24 a share at this point. Okay. So I'm underwater on this stock, not too much underwater on this stock, but when I look at a stock, I want to be absolutely fair about my assessment to myself and, of course, to the people that are watching this. So let's take a look at the earnings release from Upstart, which came out 2 days ago. There's also one from Moneyline as well. There's going to be a couple of people with questions about the price action surrounding Moneyline, because Moneyline's earnings on the whole were actually super positive. But let's remember that the stock had a pretty impressive run up from 83 cents a share or so up to like $1.18 or something. A lot of that was anticipation, and a lot of people are just taking profits on a day like this. But Upstart is a different story than Moneyline, and a different story than SoFi, which are kind of the three emerging fintechs that I've been covering on my channel. SoFi's earnings look really good. Moneyline's earnings looked pretty good, and Upstarts are a very different story. So let's take a look at that right here. So not even going to bother looking about their talking about their mission. They're basically an AI lending platform that partners with banks and credit unions, and then supposedly it improves access to affordable credit to people who weren't able to afford credit before, based on the FICO evaluation of the credit worthiness. They say that there's a lot more in the way of indicators that are going to tell you whether or not someone's a good credit risk or not. So, so they have a bunch of different areas that they're looking at here. They have instant and automated approvals, and they have a bunch of partners, a lot more partners in this. And so it's a third-party platform that facilitates loans that are made by these partners. So anyway, so we're going to take a look at this. The earnings picture does not look good at all. Okay. When we're looking at year over year and quarter over quarter comparisons, we're looking at Q3 2022 versus Q3 of 2021. It's not good, guys. It really isn't good. So when we're looking at these numbers right here, so revenues are down from about $228 million year over year in the quarter to 157 million for the quarter. And the contribution profit is roughly the same, but that means that your income loss from operations is going to be increasing. So we're at 58 million negative, down from 28 million positive in Q3 of 2021. Contribution profit was flat year over year, representing about 54% of fee revenue. And the net income loss was 56.2 million, and that's down from a positive 29 million in Q3 of 2021. Let's also remember that this stock has lost about 90 or 80 to 90% of its value in the last year or so. I jumped on this when I was beaten up, looking at getting an opportunity, coming out on the positive side a year or two from my buy point, right? Probably not disposing of it then, but not really looking to make a profit, at least for a year or two. This may turn out to be kind of a poor decision, but a lot of it has to depend, of course, on the macro environment. But you have to start asking yourself questions right now. Is it just the macro environment, or is there trouble with their model? And we're going to talk about why there may be trouble with their model going forward. Okay. So personalized unsecured lending is where they do most of their lending, which is risky, which also means that you charge more in the way of interest rates. But Upstart charges a lot less in the way of interest rates than their bank and credit union partners do for their own products, right? So they're doing a lot of small volume loans. They just added car loans recently as well, and they also have business loans. So a few things here. The Upstart model approves 43% more Black borrowers than traditional models, and 24% lower APRs, and 46% more Hispanic borrowers than the traditional model at a 25% lower APR. Now, that's based on other factors rather than just being minorities. It's based on education, job history, and all that. Those are things that FICO does not necessarily take into account. So the good news here, one of the few good bright spots here, is that bank and credit union partners are increasing. In year over year, they've gone from 31 partners in Q3 of 2021 to 83 partners Q3 of 2022, which means that their products are more widely viewed at this point. Okay. So when it comes to their emerging lending products, they launched with Upstart Auto Retail Software. Basically, they have three really large dealer groups across 4 states, and that represents about 25% of the auto market by population. And that's about 702 individual dealerships across the United States, or really across 4 states. So they have a lot more room to grow in this environment. But as we all know, or may not know, it looks like that car buying is starting to slow down as well. So the software or the company here points out that borrowers save on average $5,835 over the life of the loan, which is great for consumers, but on a risk-adjusted basis. Remember, when you're borrowing an asset like a car and you're paying a higher interest rate for, say, something you'd buy, like a home or something you'd buy, you're doing that in part because there's more risk involved in the transaction. If there's more risk in their portfolio, it may be that this amount of savings is really going to hurt them on the back end if we see higher loan defaults in this portfolio. And I'll get to that just in a moment. So the one thing that's really growing well here is the small business loan volume that went from $1 million to $10 million from the prior quarter. That just got started. It looks like they have a lot of room to grow when it comes to this. So they want us to know, of course, that there's a $5 trillion annual loan origination total addressable market. They've been in this space right here, personal loans of 146 billion. That's kind of where they broke into the market. They're just moving into auto loans, which is 786 billion, and they're just getting their mortgages off the ground, which of course pretty much is the worst time to get it off the ground. And then small business, which is 644 billion. They're just getting started, just issuing the first $10 million in loans. So Upstart's model provides 5 times more risk separation than FICO, which means that they're evaluating basically 5 times more in the way of risk factors, which they say is going to allow them to steadily predict default rate from left to right as borrowers get riskier. I'm going to say that model is maybe kind of starting to fall apart a little bit. And let's remember, folks, I'm not unbiased here. I hold this stock. This is the first indication that their risk assessment model may be in trouble here, and I want to take a look at that. So Upstart separates risk significantly better than FICO. This is the sort of Upstart risk grades that we're looking at here. So here's the thing. So the Upstart macro index measures the impact of external macro environment on loan defaults in our particular borrower portfolio by controlling for underwriting model changes and shifting borrowing characteristics over time. The current third quarter index level of approximately 1.7 equates to 70% more defaults than we would expect in a long run normal macro environment. This is not good. Okay. Not good at all. All right. So in period losses versus expected. So they're saying that the increase in defaults was followed by a stimulus driven period during 2020 where defaults were approximately 50% below expectations. Right. So they expected during 2020 and 2021 that default rates would be a lot higher, and they weren't because of stimulus. But they think that so a reversion to pre-stimulus default rates and a shift in credit risk profiles account for a large majority of the increase in late 2021 and beyond. So basically, everything here is kind of to be expected, right? So the Upstart and right now, though, they're saying that they're kind of getting into this area where it's about 70% higher than what they expected. So the Upstart platform performance versus target is starting to recover too. They had a target of approximately 8% gross return since Q1 of 2018. The platform has seen 13 vintages, which is basically just their packaged loan groups, with 5 expected to underperform, which is a change from the last. I believe that represents a change from their last earnings, but we'll see. So, in terms of revenues, though, we're looking at increased losses from operations quarter over quarter, increased net income loss, increased adjusted net income loss, greater earnings per share loss. Adjusted earnings per share loss is also a lot greater. Contribution profit is declining from the prior quarter. The margins have increased a little bit, and operating expenses have decreased. Now, they have also announced, or at least filed an indication that they're going to be getting rid of some employees as well. So that should help improve their bottom line a little bit. So here's the good news about this company. They do have a strong balance sheet. They do have a lot of cash and restricted cash on hand, about $829 million. And based on their burn rate, that represents roughly 2 years of operations here, possibly a little bit more when we take into account the money they're going to save by reducing payroll. But this is definitely not good, and it is not good for this company in the short term. However, this is one quarter, guys. It's only one quarter. There was a lot of news that happened in this quarter that was very, very negative. There's a lot of macro environment stuff going on. There was a degree of political uncertainty. But out of the 3 sort of emerging fintech stocks that I cover, this was the worst in terms of the earnings. I'm going to cover Moneyline either tomorrow or Moneylion tomorrow or next week, and they were significantly better, but they're a much smaller company than the stock, much lower market cap. Let's remember this stock traded close to $400 a share 2 years ago, and today it might be at 20, at least the last time I looked at it. So not good at all, guys. Was there anything else? Okay, so not a lot else that I wanted to cover in here, although we're seeing, like I said, a decrease in loans from Q2 to Q1, going from 311 million down to 185. That is a 40% quarter over. That's a huge loss. They're not even giving me the percentage here. So anyway, they've reduced their outlook going forward as well. Q4 revenue, they say, is going to come in between 125 and 145 million. And they're going to be losing $25 million on net interest income, which in a rising interest rate environment is not good at all. So a couple of things going on here that causes me to worry. 2 years from now or a year from now, when they want to go back and start raising money, the cost of capital now is a lot higher than it was before. And let's think about this. And there's a number of people out here that are talking about this. You can get puts on Upstart. Caroline, I started selling puts, and actually I had a put for 17 and a half that would have for 17 and a half expiring on November 18th. And I had the opportunity to dump it at a profit today. And so I stretched it out and sold another couple, I think 5 puts at 17 for December 16th. I'm pretty happy to own it at that price. which is much lower than my actual cost. But yeah, I'm definitely selling puts on Upstart. But you may even want to go lower than that if your time horizon is shorter, or if your appetite for risk is not quite as high as mine is, Catalan. That might be something you want to take a look at. Taking a look at the general market today, though, man, it's been a very, very long time since we've seen the Nasdaq 100 make these kind of gains. And the Nasdaq was up 795.95 points today, or about 7.4%. This has to be one of the largest one-day gains in the history of the Nasdaq, at least the largest since 2020. 2020, though, that's an anomalous year. You can almost throw any statistics from that year out, but those would have to be the second largest one-day gains in the Nasdaq, excluding 2020. The Russell 2000 up 6.1%. The S&P 500 up 5.5. Once again, probably I think one of the largest gains since 2020, and with the Dow Jones also being up 1,100 points. This is an overreaction, guys. I wouldn't be surprised if we see the market have a very moderate day tomorrow, or even a slight decline. Technology, of course, leading the way with the entire sector up 10%. And I guess the big surprise here, which is not necessarily good for the economy, I'm sorry, which is not a terrible sign for the economy, but it's actually surprising. Materials are up 4.2%, which that is something I wouldn't expect if we're seeing declining inflation. And let's remember that the big uproar in today's market is that inflation came at about 0.2% lower than expected. So expected inflation rate was 7.9% based on a consensus. And the annual inflation rate came out at 7.7%. Okay. So that is the first concrete evidence that we have that inflation really is slowing. It does seem to be partially because of a calm down in oil prices, partially because of a restriction of capital. But the Fed is telling us all, of course, that this is not an indication that there's going to be a pause in raising interest rates. I still expect to see a raise in interest rates next month. I wouldn't be surprised, however, if we only see a 50 basis point rise in interest rates, which would put us at 4.5. I think like 4.25 to 4.5% by the end of the year. So that would not surprise me at all. Okay. The sector that performed the worst this year, or today, was energy, is up 1.92%. Oil was not up very much today. I think it's somewhere around $86 a barrel. But that actually, the fact that energy lags doesn't surprise me, because energy is the only sector this year that is above water. Even after today, the economy basically is telling us that every sector is underwater except for energy. So let me see. Catalan Divine says, I believe that when the House gets called, it will help the market to continue up. It may help the market to continue up for a day or two, but that is about it. Elections, in our House elections, and control of the House, whoever wins the election, does not have a long-term effect on the economy, or not on the stock market. Who runs Congress, who wins elections, doesn't really have an effect on the stock market beyond a day or two. The reaction is generally that when Democrats win control of Congress, market is down for a day or two. When Republicans win, market is up a day or two, for the erroneous belief that one party is better for the economy than the other. So, and that's the party that people think is better for the economy is demonstrably not true. Okay, that is not a fact. In fact, you can look and find out, when the economy performs better in terms of GDP growth, private sector employment, stock market performance, all of that stuff, and you'll be surprised by the answer. But I don't pay any attention to elections when it comes to my investment strategy. Not that I don't pay any attention to elections when it comes to investment strategy, but I'm not worried about who wins on election day. What I'm worried about is long-term policy. And some of the long-term policies that are really good is that we are investing in a future economy today, and not investing in the economy of the past. The CHIPS and Science Act was really good on the surface in terms of the money that it puts forward to help our chip industry to reshore some of that. But the big help in that regard is coming from the sanctions that were placed on China recently, that are going to make it almost a certainty that a lot of that manufacturing has to go to Taiwan, the Netherlands, the United States, or Switzerland. And these are all places that are very friendly to us. And I think a lot of it's going to end up coming to the United States and the Netherlands. And there's a couple of different reasons for that. So I followed the semiconductor industry for a very, very long time. It is cyclical, folks. We are in one of those periods of dislocation, and we are going to see things shake out. And if you guys paid attention lately in the last couple of weeks or so, Nvidia's done really well. It's up from a bottom of about $125 a share, where one of my puts was executed on that and ended up disposing of it at somewhere like 139 a share. It's beyond that at this point. And yeah, and the reason I did that is because I really don't like to own things on margin, and that's the only reason I sold a call on that. Or no, I didn't sell a call. I ended up selling it when I got to that. I wasn't paying attention, and when it got to 139 share, I sold, largely because I just don't want to have anything on margin at this point. Yeah. So anyway, fire away with questions that you guys have. We're going to talk a little bit about what's going on, and one of the things that I wanted to talk about is where inflation is cooling off, falling costs for used cars, trucks, medical care, clothing, and airline fees. But food costs are going up, and that's something that everyone sees every day. You may not see things like the price of cars, trucks, medical care, clothes, and airline fares. That may not be a daily part of your life. Food is, though, and and as is the cost of shelter, personal care, and that sort of thing. So those are to a large degree, that is what is causing the dislocation between people that see inflation being rampant and the fact that the Federal Reserve is saying that that it's declining at this point. So it's where inflation is happening. The concern that I have is that companies right now are also starting to reduce their forward guidance when it comes to what they're going to be earning in the next couple of quarters, or over the full year guidance and that sort of thing. And there's two reasons to look at that. They may in a lot of these companies that are making these predictions or giving us forward guidance, they're also in the process of executing pretty large layoffs of really high paid employees, which also is normal in Silicon Valley. That happens every time there's a downturn. The easiest fat to trim is your largest expense, and that is labor. And so, I mean, and don't feel bad for these people yet. They, at this point right now, they're still able to find a lot of jobs elsewhere. But the thing to look at that is they may be reducing expectations on purpose going forward, so they can have a fair degree of outperformance in the next couple of quarters when it comes to their quarterly reporting and things like that. It may be a very cynical way to manipulate expectations. And to some degree, I think that's the really big tech companies are the ones that are really, really guilty of this. Yeah. Yeah, let me see. Says, Steve O says, do you see Tesla going down into the low mid 100s by year end, or has it bottomed? Tesla may not have bottomed, and there is a couple of different reasons for that. Tesla's never been fairly valued. It's valued based on its growth rate. Based on its growth rate, even it's just now approaching the point where it's kind of fairly valued, right? But when I look at the sort of long-term potential of this company and their ability to maintain, they're not going to be able to maintain 50% growth forever. Like, I think that once they hit 3 or 4 million vehicles per year, especially with the limited lineup of vehicles they have, if they don't introduce more models, it's going to be very difficult to really, let's say 3 million vehicles a year. Once they hit 3 million vehicles a year, if they don't have other models introduced and with scaled production, I think that their growth rate is going to slow pretty significantly after that. And if you look at what do they really sell in terms of volume, it's the Model 3 and the Model Y, and the Model X and the S really don't sell a lot in the way of volume. So they really need to come out with the $25,000 Tesla vehicle. If not a $25,000 Tesla vehicle because of inflation, there should be a $30,000 vehicle that's out there, and the Cybertruck. The Cybertruck, because of the way it looks, that look may fail. Let's remember though, that look can be adjusted, right? The way the car looks is a huge part of its of what's created the buzz, but it's also created a really polarized reaction to the vehicle. Like my wife, for instance, absolutely does not want me to get a Tesla Cybertruck. We may end up getting a Tesla Cybertruck. I don't know. I've kind of I was thinking about buying a Ford Lightning, but because of the recent price rise on that, possibly not. But I'm still kind of considering whether or not I want to do that. But in the end, I think that by the end of next year, they may have a production capacity of about 2.9 million vehicles. They're going to hit about 1.5 million vehicles in terms of what they've sold this year, I think. By next year, they really need to hit like 2.25 million vehicles sold to maintain that 50% growth. I think it gets more difficult after that. I really think that it gets more difficult after that. And that's when we need to start reevaluating where we think Tesla is going to be. If they grew at 25% after that, that's still a massive growth rate. I tend to believe that they will top out at somewhere around 7 to 8 million vehicles per year. I do not believe that Tesla is going to end up making 20 million vehicles a year. By the time they scale production that high, there's just going to be too much competition in the space to do that. And there's going to be there's bound to be a bit of brand fatigue also, unless they can turn themselves into the Apple of vehicles, which there's somewhat of an indication that they've done that so far. And just like Steve Jobs, Elon Musk tends to be a polarizing figure. So no, don't. I believe that it's possible to go down to the mid 100s. I bought a few shares, today, and a few shares yesterday, a few shares the day before that. I didn't catch it in the 170s when it briefly dipped down there, but I did buy a couple of shares in the 180. So I'm definitely still bullish on Tesla, but rather annoyed with the Twitter distraction. But let's talk about that for a minute. I think that there should be less of a big deal made over the amount of people that Twitter is letting go at this point. So I don't know, and there's a couple other things. A lot of people have forgotten that that Twitter was ordered by the SEC to cooperate with a security agreement way back in 2011, where they had to maintain these security protocols. Well, basically, the head of security and one other person involved with that department just quit today and left the company, stating that Twitter is not in compliance with that agreement anymore, which opens up Twitter to billions of dollars in fines and lawsuits. Okay, that's another issue. There's also the issue with the now an employee lawsuit going against Twitter because of the way that they were let go. All right, because there's a process for if you're going to let go more than 10% of your workforce, there's a process that has to happen. Because of that, it wasn't followed in this case, and there's other things. It also turns out that there's significantly more shares that were liquidated, and I think that is of Tesla rather, which added to selling pressure. That may be done for right now, but it's at least another $4 billion that was liquidated out there. And I think that Elon Musk is just kind of preparing for a bloodbath. But here's the good thing that he's done with this, and we just kind of discussed this on my last live stream, where I really don't believe that there's going to be a sea change in the way content is moderated if they expect to have an advertising model at all, because the way that content was moderated before was perfectly in line with capitalism and the principles of capitalism. You have advertisers that are selling on your platform. They don't really care about the freedom of speech. They want to put their products in front of people whose values and desires align with what they're selling. And if you become a cesspool of hate speech, they don't want to be associated with those people, no matter how green their money is, because being associated with them means that other people speak with you. So I don't believe that content moderation on Twitter is really going to change that much. And I don't believe that a subscription model is going to work just based on the numbers and the prices that he's throwing out. $8 a month for a check mark. You need 10 million people at a minimum just to replace advertising dollars that were lost in the last month. Not going to happen. So advertising is always going to be a part of Twitter. there's probably a better way to monetize that content. And there's probably a really good way to get creators to have their content monetized like it is on TikTok very poorly, or like it is on YouTube fairly well. I think creators on YouTube get 55% of advertising revenue, and YouTube gets 45%. I don't know if Twitter's ever going to do better than that, but they may open up the video format to longer videos. You may see more videos served to you than are served now. There may be even a way to monetize for creators of just tweets, text tweets, to be able to monetize that as well. That could actually cause a sea change in the way that Twitter is able to monetize business. But content moderation, I don't see it changing greatly. I really don't. I really don't. There's always going to be bomb throwers on from one deplorable section of society that want to say whatever it is they want to say without realizing Twitter is not the public square. It's an advertising space where people sell advertising. That's what it is. So when I say that the content moderation was in line with capitalist principles, it's one private company managing their platform to do business with other private companies who want to sell products on and services through Twitter. If that basic calculation doesn't change, content moderation is not going to change too much. So, and a lot of the problem with content moderation was not humans, it's how the algorithm was written. And hopefully that algorithm can be written in a much better way. I think one of my favorite fact checks was when people were tweeting in 2020, a joke meme about the coronavirus victims rising from their dead, and there had to have been a fact check on that. It was on Facebook and it was on Twitter, and I thought it was hilarious when it showed pictures that were screenshots, of course, that were taken from The Walking Dead, talking about coronavirus victims waking up and eating people, and there had to be something on there saying that this was fake news. Obviously, that should be viewed as satire. I think that, of course, that an AI is not very good at differentiating between satire and actual fake news. For a lot of different reasons, I think it's going to take a lot to change the way content is moderated. But how Twitter is monetized, that's a different story. There's a lot of different possibilities out there. And so here's the thing when it comes to the employees as well. The cuts are really, really deep, but they have to be really, really deep. And because that is the largest expense of Twitter is their labor expense. They've lost some advertising. It's going to take a while to regain confidence in the platform. And I don't think that it's going to become a free-for-all dominated by Nazis or anything like that. But I think it's just going to take a while for them to reach the road back to profitability. But that's going to occur in an environment where capital is very expensive too. When you're looking at the risk-free rate of a treasury right now, a 3-month treasury at 4%, and then you think about the risk premium you need to get on top of that 4% in order to justify a loan to Twitter or a secondary offering. If this is a secondary offering, I want to be confident that that Twitter is going to make me, and you can't do, it's a privately traded company now, but if this was a bond or something like that, that bond's going to have to pay 10 or 12, you're going to have to yield 10 or 12% in order to convince me to buy it. Because the fact that it's losing money right now, it's a private company, one guy's in charge of it. I can get 4% on a 3-month treasury, or I could buy a bond issued by Twitter at 4% or whatever they want to issue. I'm not going to take the risk to do that when I can get 4% risk free. So the premium on raising money now is going to be a lot more. And the premium when outside investors are looking at how do you invest in Twitter, like buying, we're talking about private equity, their calculation is going to be somewhere north of that 11 or 12%. That's the yield they're going to have to expect on their investment on an annualized basis in order to justify that over other types of investments that may be a little bit less risky. So he's got to trim the fat kind of in a really radical way to make, in order to attract investment in the next like 3 to 4 quarters. He's got to demonstrate that they're in much better financial condition than they were the day he took over that. And a large part of that is going to be cutting expenses. A large part of that's going to be cutting expenses. So, yeah, let me see here. Let me answer a question from Steve. Oh, did you buy Marvel Technologies? I think you reviewed this semiconductor on prior live sessions, but a refresher would be appreciated. Marvel earnings would be 12.1. Thanks again. Yeah, I've done a live stream before. And like I said, beyond NVIDIA, the only I don't own any stocks semiconductor makers anymore, largely because the everyone in the industry is so closely related that it doesn't make a ton of sense to own that. Yeah, it's just like a part of my Discord. I got on there today. I was like, hey man, before market open, I looked at futures like, man, today's gonna be a crazy day. So here's what's gonna happen. There's gonna be a lot of activity. There's gonna be a lot of people buying back call options that they sold because they made a profit on them at this point, or they don't want to eat the taxes on it. There's gonna be a lot of people that are buying back put options because they made so much money on that. And there's gonna be a lot of people short covering, right? A lot of people short covering. So Marvel Technologies is has been around for a very long time, and it's been a very popular stock for a long time. They do have like a small dividend that they pay, which is at this point, I think they may have started that back in the 1990s when that was kind of more of a thing for these semiconductor makers, and most of them pay like really small dividends. Even Nvidia pays a really small dividend. So they have a loss of 60 cents per share right now. Beta is about 40% higher than market. Let me see here. And earnings for these guys are always going to be all over the place. But when we're talking about revenue and earnings, always going to be all over the place when it comes to semiconductor manufacturers. Let me see here. Yeah. So when it comes to semiconductor or circuit board manufacturer, always going to be all over the place. Earnings beats over the last 4 quarters. Interesting that guidance was still so high after last quarter when it comes to consensus earnings per share. I think there's a small. This wouldn't change whether or not I invest in this company or not. If I had made up my mind on this, I definitely have not. But this quarter probably wouldn't change my mind overall. But based on what I know so far about this industry, and based on the consensus earnings per share, I think there's a pretty good chance that they miss. When I say pretty good chance, it's north of 25%. If I were to put a probability on it, there's a greater than 25% chance that that Marvel is going to miss earnings this quarter. It would be the first quarter in a while. They have seen like pretty outstanding increases in revenues over the last couple of years, but they have not seen a corresponding increase in profitability. This is yeah. So did you guys see the announcement from NVIDIA though that they have already produced a new version of a chip? And I want to know how they did this so quickly that they think is going to be in line with all of the sanction standards, and they're going to start exporting that to China. It's not going to have some AI capabilities associated with it, but yeah. So Steve-O, Marvel Technologies, we need to, and I have not seen any announcements of how they're going to deal with the sanctions either, and still keep China as a market. So that's very, very interesting. Synopsys is one of the other companies. S&P is that you probably should look at, right? This is another semiconductor manufacturer. This is another company you guys should be keeping on your list if you're interested in talking about semiconductor manufacturers. The stock is up 9.89% today. I definitely wouldn't buy into it today. I don't think bad news is over for the market. I think that today was great, but I don't think that I don't think we're done with a little bit of trouble. Now, there have been a few predictions from experts out there that we could be looking at S&P 500 at 4,200 by the end of the year. I do not necessarily share that enthusiasm for the S&P 500. I think there's actually an equally likely chance that we decline all the way back to 3,600 by the end of the year based on news here or there. The big jump up today is just that news has been so bad for so long that the market jumped on any news that was good in order to run up, and it's been fun. Don't get me wrong, but it's not something that I'm betting on continuing on into tomorrow. And I'd hate to. I mean, I'd love to be wrong about that. I would absolutely love to be wrong. But in terms of Marvel or Synopsys, in a lot of ways, Synopsys looks like a better buy in terms of their current cash flows. Number one, beta is a lot lower. Two, price, they have a price to earnings ratio. Earnings per share is 6.55. They've been profitable for a very long time. Their earnings are all over the place in terms of the last couple of quarters, but they've shown really steady increases in revenue and fairly steady increases in earnings over the years. Of course, I expect this year to be not quite as good as last year, and 2023 to be possibly a little bit more challenging. But I think that in terms of if I was looking to buy a stock in that sector, an individual stock in that sector, Synopsys would be one of the better bets. And I also like the fact that this is not a company that is covered a lot in social media. I run a couple of like social media queries on Synopsys, and in the industry, it actually has a lot less coverage from social media folks, and I think that has a lot to do with why it's a lot less volatile than a lot of these other companies are out there. And if we are looking at growth of this stock over the lifetime, it's looked pretty good. They've been around since 1990, 91. And we've seen a huge run up in the value of the stock since about 2016, since semiconductors or since chips started being put in everything. But in terms of their future prospects for growth, they're still pretty good, right? This is a company that I like a lot. I'm trying to think of the name of the company. Trying to think of the name of the company that's located in Holland that I think is really going to fit. Uh, it's not this. It's not KLA, but there's another company I think is really going to benefit from the Inflation Reduction, not the Inflation Reduction Act, but from sanctions on China and export controls on China. And it's a Dutch semiconductor manufacturing company. I think they're going to do exceptionally well, just exceptionally well in the live stream to make sure that I talk about it. But yeah, anyway, you guys fire away with the questions. Did want to talk a little bit about Bitcoin today. Bitcoin today was up big. I think up 13 or 14% at market close. Of course, the market doesn't close for Bitcoin. But like I've discussed before on this channel, the stock market and Bitcoin should not be correlated, but they are. Right, at least since 2020, it's shown a really high degree of correlation. The FTX crisis. Not Holland, the Netherlands. Feel free to ignore this Dutchman. Ik kan Nederlands spreken. Yeah. Okay. I grew up in rural Texas. We called it Holland or the Netherlands, and people never knew what we were talking about. So Bitcoin pairs losses, but the FTX crisis lingers. So FTX is toast. And I can never remember the name of the guy who's the head of FTX, but he suffered the largest single day decline in wealth in terms of percentage, probably of any billionaire in history. He lost 94% of his wealth in a single day. And yes, George, you are correct. ASML was the company that I'm thinking of. So this is a company in the Netherlands, not Holland, sorry, but a company in the Netherlands, and I think they're going to be one of the big beneficiaries from the sanctions that the U.S. has put on China and export controls that the U.S. has put on China. So there's a big meeting between Joe Biden and Xi Jinping on Monday. I would love to be a fly on the wall for that meeting because Biden basically pantsed Xi Jinping with these export controls. And this is the strongest economic action I think that the United States has really taken against China ever. And really, it's in line with forcing the world to stop buying Venezuelan oil, forcing the world to stop buying Iranian oil, that sort of thing. I mean, that's how big of an effect this is likely to have on their economy, at least in the short term. This is not a technical problem that is insurmountable for China. It really isn't. But it's going to take time and money to solve some of the issues that are going on there. But this is the largest move that anyone's made against them. And the point has been made by a couple of futurists, thinkers about the economy, demographic trends in China. For all this talk of China becoming the largest economy in the world over the next couple of years, most economists don't believe that it's going to be for that long. And there's a significant minority who think that the next 5 to 8 years in China is going to be the best that China is ever going to get before the inevitable demographic collapse starts to set in. Now, they could manage that demographic collapse well. Who knows? The problem is there's no roadmap from any other society to look at for doing this who manages this successfully. There's no roadmap for that. They have a massive host of problems to which there are no solutions because no one's ever thought of them before that come along with an aging and declining society. So then I'm not 100% in this camp, but I will say that the population in China is going to go from like 1.4 billion to about 500 million by the end of 2100. Without significant immigration, their population is going to shrink and shrink and shrink and shrink. And how willing is China to allow immigration like the United States is? The United States allows mass immigration, and we aren't having a problem with population growth or demographic collapse or anything like that. But that's a possibility and it's on the horizon. We're seeing some of you folks that watch my channel aren't old enough to remember that when I was a little kid, we used to hear that the average woman in Mexico was having like 6 kids, that that they were going to be overpopulated and they were going to be starving in the next generation or so. And now the average woman in Mexico has like 2.1 children or something like that, which was standard for the United States up until like 1974 or something. So and so population growth declined pretty rapidly as incomes rose in Mexico. So we have the fastest rise in incomes in China, 14x since like 1985 or something like that. Incomes have never risen faster in any part of the world, at least any large country like that in history. And now we're starting to see a decline in population, right? So the decline of population in China started a while ago, but we don't know what's going to happen. I guess so China and Japan are very different societies. So Japan is not going to provide the best roadmap to deal with deal with this, right? Because they're so radically different. But I can tell you what China did very well, Japan did exceptionally well. Chain in terms of manufacturing, more complex, more expensive goods with much higher margin. Japan did that fairly steadily from the very beginning, and China really just started doing that in the last 10, 15 years. I don't know if they made that change fast enough. I don't know if they can handle this. So to me, there's more uncertainty. We talk about China may be the largest economy 10 years from now. I don't think it's going to last. I don't think it's going to last. Doesn't mean that everything's going to be bad, but it does mean that we're in for a very interesting generation. I think Gen Z is going to hear things that people said about China when they're my age or as old as boomers are today, and they're just going to laugh at some of the things that we said. So very interesting. But to be a fly on the wall in that meeting when basically the United States slapped China in the face, and they weren't very polite about it either. And as Bram pointed out in the last meeting, I did have a chance to look up. Canada kicked Chinese lithium miners out of Canada as well, which was very interesting. I would expect, because lithium is the new gold and there's going to be a lithium gold rush, I would expect that's going to happen in a lot of places without China stepping in and really offering something to these countries in return for access to their primary materials. So I'm very, very interested to see what happens in the future. All right, guys, not getting a lot of questions today for some reason. Let me see if I missed anything. You see, I did say tell 666-999, who always attends. Thank you very much. Did want to say, though, that today it looks like the market as a final is up 1,201 points. Absolutely amazing. One of the best days, since the 2,000 point days in way back in 2020. So control of Congress is still not decided. Like I said, though, I don't think it really matters that much. And especially, I will say that the red wave didn't happen at all, really. I thought that was really interesting in terms of, I didn't find it so interesting because I didn't realize its impact until I read an article that pointed out that on average, the party that has the White House loses 43 seats. And that's basically been true since the 1880s. And Congress has basically has changed hands, or has lost, has had a net loss in seats close to that number in all but two cases, all but two times, and one of those was in the last 20 years. I don't remember which one that was, but yeah, it's really interesting how poor the performance was in terms of the party out of power. They generally perform a lot better. So big news here that can't remember who it was. So Tesla bulls cut their price targets. Developers automakers cancel solar projects across the nation. There was a big firm that took Tesla off of its list of good ideas, and I don't remember which firm that was. It wasn't Merrill Lynch. It may have been Morgan Stanley that took Tesla off the list of good ideas. I think that that's relatively premature, and I do think that Tesla is going to be tied up, or Elon Musk is going to be tied up with Twitter. But Elon Musk is not the only person working for Tesla. They have really good junior leadership below him in place, of amazing engineers, and they have a workforce that is highly motivated to make money. So, yeah, Dan Ives from Wedbush. That's who it was. It was Dan Ives from Wedbush. He took it off of his list of great ideas. USA, the average IQ is 98 and average IQ in China is 104. Actually, that is not true. So the average IQ in the US today is 98, but compared to a chart back in the 1960s or 1990s and the IQ research was done, it would have been 100. That was the default. What they used in that research, which was, and I can't remember the guy's name who did that, but there was a follow-up to that written called it was called the mismeasure of man, and the bell curve is what I'm talking about. The average was actually 104 for Chinese, or for Asian Americans, not people in China. We don't know what the average IQ is for people in China. So that study where we got average IQs for different ethnic groups and races in the United States, that was all done in the United States. And there hasn't been a great deal of worldwide IQ testing to tell us what's going on. A lot of it's done by estimates, and you shouldn't really test any of that. But so the rebuttal to the bell curve is a book called The Mismeasure of Man, and it was written by Stephen something or other. I can't remember, but it's a great book as well, where it talks about all of the different methods that we've used to estimate intelligence over the years and how they've turned out to be really not well done. So here's a problem with the U.S. is that even if IQ is 98, and average should be 100, right? That should be the mean. IQ should be 100. But even if it is 98, that's not where our problem is. Our problem is we let people below an IQ of 98 have plenty of power. That's the real problem. So it should be people with IQs over that 98, preferably 2 or 3 standard deviations over 98, who have all of the power in the U.S. Unfortunately, we operate our democracy on the basis of a popularity contest, not much better than electing your class president in high school. And this is the reason why we find ourselves in our state. China, on the other hand, you don't have a choice in who runs your country. It may be that everyone running the Communist Party has an IQ of under 104. You don't know that. And the thing is, I don't know either, but I have a strong suspicion that a really strong suspicion that if you took the IQ of everyone in the House of Representatives, that it would be right at average. You're going to have a few members, a significant number of members that have IQs that are well above average, and a significant number of members of Congress that have IQs well below average. The problem is they all get one vote. They all get one vote. And that's, as George Carlin said, think about how dumb the average person is. Okay. And in Congress, they all get one vote. Yeah. Anyway, that's kind of our issue, is we need a better filtration system for selecting our candidates rather than who looks the best on TV and creates the best sound bites. And until that happens, I think that our democracy is is still going to be threatened. And it's threatened by a tidal wave of stupidity. That is the largest threat to American democracy. And I think that's the largest threat to democracies everywhere, is that your democracy is constantly under threat of well-intentioned people making promises to a lot of people that don't think very far in the future. So that's kind of my issue there. All right, guys, we are coming up on an hour, and I do have a bunch of errands to run today. My daughter, yeah, yeah. Michael Wood says, I think you just summed up democracy everywhere. Yes, possibly, but I really think that every democracy as a society just needs to do a better job of saying, hey, is this what I really want for myself, who I want to represent me, or is this someone that I think is going to improve society for everyone in the future? Make sure that everyone has more opportunities to succeed, and everyone has an opportunity to live a life of dignity, and everyone has universal human rights. And I think this is just like three basic questions that people never ask themselves whatsoever when they're choosing a candidate. So to me, if I'm choosing a candidate to vote for, those are the only three questions that I need answered, regardless of what party that they're in. That's it. Those are the only three questions I need answered. You're a decent person if you think that everyone deserves universal human rights, a life of dignity, and that this entire country as a whole needs to be offered. Not our entire country, but every democratic society needs to do everything in their power to offer more people more opportunities to succeed. Not to limit success to certain slices of the population, but give everyone a chance to succeed. And I don't care what party you belong to. If you can promise me that those three things are a part of your platform, then I'll definitely consider voting for you. But there is a shocking amount of politicians in Western democracies that today will fail on 2 out of 3 of those questions. A shocking amount of them. But yeah. All right, guys, I'm going to close this one out today. I do want to thank everyone for attending. It's the first time I've ever done so earnings on a live stream with Upstart. I'll probably do just an outright video for MoneyLion. MoneyLion looked a lot better. Upstart's earnings were really a train wreck. And that's it. And I don't see a lot of positive coming out of them until they really demonstrate an improving bottom line. So strangely enough, I think that MoneyLion, because of their focus on profitability and narrowing loss rather than just growth. Yeah. And I think that because of that, that's actually going to give them greater access on a comparative basis to capital going forward than even possibly, definitely from Upstart, even though they have a much higher valuation. It may give them greater access to capital than some other fintechs that are out there. Maybe not SoFi, but some other fintechs that are out there. They look like my question is I don't understand. A lot of the questions I have is I don't understand everything they have on their platform, and I'm having a hard time wrapping my brain around the entirety of their business model. Unlike SoFi, where it's very easy for me to understand because it actually just resembles traditional banking. It's just been all moved online. MoneyLion's strategy is a little bit more opaque to me. And part of it is I think that everyone involved in MoneyLion is just a lot younger than I am, and they have different ideas of how the financial world should look. So I'm going to be taking a look closer at that, but their earnings actually look pretty good, and we'll cover more of that tomorrow or next week. So Michael Will says, I have a family member that's standing for an election as an MP in London. I've had insight into the process. It's a popularity and soundbite test. So that the real thing is, I've lived in a couple of different countries that had parliamentary democracies as well. And the thing that blew me away is you don't have primaries. Not that the primary system is perfect here, but you don't even vote for the people who are running for the party. The party votes for the people who stand for election. That's kind of the case here, but it's democratized too. I can vote in any primary that I want to. You guys don't get to do that in most parliamentary democracies. I don't know exactly how it works in the UK, but I know how it worked in Belgium, where I lived, and nobody got to vote for the party, for the person who represented the party in the election. And it caused a lot of disillusionment. But they also have mandatory voting there, or at least they did. I don't know if they still do, but they had mandatory voting at the time. And we have a country where we won't even make voting day a national holiday because certain people want to make sure that the working poor don't get to vote. And yeah, so I think that's very, very interesting. And it's just it's a method of voter suppression, and there are hundreds of different methods of voter suppression that are out there, and I think it's criminal. But anyway, and I, for someone who says they don't want to talk about politics on their channel, I sure do talk about politics a lot. I'm relatively sure that I've been losing subscribers in the last month, and I think it's because I've been addressing politics over and over and over. And the fact is, if you're not far left or far right, then you can't attract anyone talking about politics in a channel. So I'm not far left or not far right, and I'm pretty much in the center here, and that doesn't make for good TV, and it doesn't make for a lot of controversy when I'm willing to listen to the other side and consider what they have to say and that sort of thing. But anyway, I am going to call this one a day today. We are right at an hour. Thank you so much, guys. I'll see you for sure next Monday. And I'm probably going to put out a video on Moneyline sometime this weekend. I'll talk to you guys later. Thank you very much.